Wow, the Federal Reserve minutes just came out, and I have to say, at the Fed meeting, how we got this like really hawkish Powell. Remember before the Fed meeting, how I predicted like if Jay Powell gets his 50, he's gonna have to hawk. And that's what happened. Now, I wasn't expecting some of the things that ended up happening in the market, but we thought if Jay Powell goes 50, he's gonna hawk. And he hawked that. I mean, he hawked to us. It was crazy how much he hawked. He's like, everything's fine, the economy's fine, everything's fine. Well, when you actually look under the hood, it's like, oh damn, this 4-cylinder is about to bust. It don't look very good. And I'm gonna just restrict this conversation to the most important part of what came out of these Fed minutes, and let's discuss them and talk about pricing power and what's going on here. But it's actually potentially a lot more dire than Jay Powell really let on at the last meeting. And I think it's important to have this discussion of, if they screw this up, it's very difficult to fix. Think about this. You can fix low inflation by printing more money, but you can't get jobs back once they're gone. And folks, that's like the definition of what we just saw in these minutes. These minutes highlight a dovish Fed, not the hawk that we got from Jay Powell. Let's go into some of the minutes together and see what we've got here. So this is the section I want to get started in. We already know they're going to be data dependent. All the reports are going to matter, blah, 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 blah. We already know that the last jobs report was basically 785,000 government workers. We already know that in the household seasonally adjusted level. That is 785,000 government workers out of nowhere, out of somehow appearing in payrolls, lowering the unemployment rate with this massive seasonal adjustment. After you remove all the teachers, you still get a 785K boost. That means you actually lost like over 250,000 regular jobs. Yeah, it wasn't a good labor report, although everybody's been cheering about how great the labor report is. Well, listen to the Fed here, because if you go to the Fed minutes, you go to page 7 and on, this is where you're going to see the biggest pain. First, I want you to see some of the things that the Fed is really worried about. First, they see a modest slowing in GDP, but that's just the start. As GDP starts slowing, I understand GDP was hot with estimates in September, but you have to also keep in mind the September pull forward may have been heavily due to the port strikes. Salespeople calling up going, hey, get your order in now before those port strikes shut everything down. Obviously, those are over now. And in fact, when you look at wholesale trade numbers that we got this morning, they were 0.5 percentage point worse than expected. So we got substantially worse wholesale trade numbers this morning, which is somewhat indicative of, yes, we had a pull forward last month, but it ain't going to last with some of the data going forward. And the Fed is keenly aware of this. They see a slowing of real GDP coming. On top of a slowing of a real GDP, they see waning pricing power. And I understand everybody wants deflation. Like, that's the thing. It's like, yay, we want lower prices. But people forget that deflation means businesses can't show growth. When businesses can't show growth, stocks don't go up. So what do businesses do when they can't show growth on the top line? They show growth on the bottom line. They do that hopefully with lower input costs via commodities or producer prices, or they cut jobs. And that's the problem, because even the Fed in these minutes acknowledges that while companies aren't conducting layoffs, they are hiring less. People who are quitting jobs aren't getting the pay premium they used to. And companies are just, kind of letting people go via attrition and then not rehiring them when they leave. They're doing more with less. So while it sounds good to have increased productivity, remember, increased productivity is another way of saying we need fewer workers. Waning pricing power means we can only grow EPS through fewer workers. So, think about this for a moment. In an anchored inflationary expected environment with slowing GDP growth, I'm going to put down arrows for every time it would push jobs down. Slowing GDP growth, jobs down. Waning pricing power, jobs down. I actually think there are very few companies, if any, that actually have pricing power right now. I think it's a pretty precarious time, especially where valuations are. Increases in productivity reduces the demand for labor. A softening in commodity prices, that could be neutral, so we'll leave that one unmarked. Several participants noted that nominal wage growth had continued to slow, with few participants citing that it was set to decline further. That reduces consumption, which starts the cycle of more layoffs. These signs include lower rates of cyclically sensitive wages and data indicating job switchers were no longer receiving the premium over other workers. Some participants noted that wages were a relatively large portion of a business's costs in the service sector, and that service sector deflation would ultimately be assisted by nominal wage growth. In other words, inflation's not the problem. We're probably going to see more disinflation, but that could also come, especially since jobs are a large portion of a business's cost in the service sector, potentially also jobs down. Several participants noted that supply and demand in the labor market was roughly balanced. Wage increases were unlikely to be a source of wage pressures. We've heard Jerome Powell talk about this before. With regard to housing services, some participants suggested we could see more rapid disinflationary trends coming. This basically means more disinflation, less inflationary risks, more labor market risks. The labor market was now less tight than it was just before the pandemic, and some participants stressed that rather than using layoffs to lower labor demand, businesses had instead been taking steps to post fewer job openings, reducing hours, or making use of attrition. That's what we already talked about. Participants observed that the evaluation of labor market developments had been challenging, with increased immigration, revisions to payroll data, and possible changes in the underlying growth rate regarding productivity. In other words, it's kind of like the Fed feels like they're flying in the clouds with no instruments. This is bad. They're basically saying we can't fully trust the data right now. And what we're starting to see is that labor is weakening and inflation's less of a problem. So way less of an inflation problem, way more of a labor problem than Jay Powell led on at his press conference. Now, participants indicated that the baseline is that the labor market would remain solid, but some also argued that once you get labor market easing, the risk that easing could transition to a more serious deterioration increases. And the problem with that is once you start, they say it themselves, once you start having, I can't remember exactly where it was, but basically once you start getting a weakening in the labor market, it's really hard to fix it. Now, they said that business contracts were optimistic about economic outlook, but they were exercising caution. This is something you saw in the Beige Book as well, where they're basically like, we're looking forward to a good Q4, but what if we don't have a good Q4? What if the holiday season sucks? What about these slowing expenditures or these strains on household budgets and delinquencies and credit cards and automobile loans, and the fact that the level of 27 weeks of unemployed workers has been rising substantially, and the only time it rises substantially is in a recession. Right now, the stock market and bond market is only pricing in like a 15% chance of recession. Nobody is properly positioned for a potential recession here. But then again, this time's different. We're going to have a soft landing. A couple participants, however, did not perceive an increased risk of further weakening. These are the people that actually kept the Federal Reserve, in my opinion, from going with a 75 BP cut. I think there's so much stress coming from these Fed officials that most of them are like, no, the upside risks to inflation have diminished, and we've got big problems potentially on labor coming. And a sharper than expected slowing in consumer spending in response to labor market cooling, or because of these lower budgets from lower income households, could make it even harder. It's also, remember, worth always considering that once the labor market weakens, it's a lot harder to fix it. Take a look at this. A few participants highlighted, in particular, the costs and challenges of addressing such weakening in unemployment once it is fully underway. In other words, if you get a Fed here that is blind to the downside risks, they are going to drive us into recession. And even though we got a hawkish Powell, if you actually read that labor report, I wanted to go bullish off of it. But if you actually read that labor report, and if you actually look at the data and you go, oh man, table alpha 8 is really bad, private payrolls are falling, government employment up, after having already subtracted out your teachers going back to work. Oh, and then how does that compare to prior Septembers? Oh, well, if you look at prior Septembers, it's really bad. You have non-farm payroll levels, huge adjustment up, while at this, which is something you haven't seen before, while at the same time, you have the people actually responding to the survey at record lows. These are bad things. Look at the adjustment that you got in the government payrolls right here. You have 3 giant red lines like this. Once in July of 22, December of 22, and once in this last report. You know, hey, you know what? Maybe just ignore it. But to me, it's a red flag, and that is a dovish Fed. And I think right now, the fact that, it still blows my mind that yields have risen as much as they have, but I think the higher yields go right now, the greater chance of people flirting with recession. I personally am of the mindset that, and this is not personalized financial advice, but my mindset is pay off margin. Please, I don't want to see you go bankrupt from margin, okay? Pay off margin. Think about diversifying. Raise some cash. Raise some cash for a post-election dip or something, okay? But it is okay to take some profits from the Vegas table. Protect yourself. That is a dovish Fed. And if you think that labor report was good, you did not read table A8. Look it up yourself. Type it into Google. BLS labor report. Click on it. Scroll to the bottom. PDF. Click on it. Scroll to page 18. Alpha 8. Then read private payrolls, government payrolls, seasonally adjusted and non-seasonally adjusted. Read both of them. And you will not think that jobs report was good. Good luck, everyone.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.